if I could sit down with somebody and show them how we look at companies, I think they would look at the market itself and say, gosh, I'm taking a lot of risk for what I'm getting back right here. So they would pass on it. And that's when you realize you're in this sort of mania bubble, when people quit thinking about the fundamental return of something and they start just thinking about the price. I want to buy this because I was at a cocktail party, somebody bought it, they're making a lot of money, so I want to buy some. Well, that's not a great reason to invest. And you certainly wouldn't ever buy a piece of real estate like that. So, but that's what people are doing in the stock market right now.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. As 2024 draws to a close, the mood on Wall Street is very jolly. Stocks are back to trading near all-time highs. Positive sentiment, be it among investors, businesses, or consumers, is suddenly spiking. So, is such exuberance merited? Should we expect the market's good times to continue rolling into 2025? Or is the optimism overlooking risks, both valuation-based and structural, that may make next year a much more challenging one for investors? For answers, we turn to the experience and wisdom of financial advisor Ted Oakley, managing partner and founder of Oxbow Advisors. Ted's got over 40 years experience helping clients, mostly high net worth families, protect and build wealth through good times and bad. We'll find out how he's currently positioning his clients' assets for the coming year. Ted, it's wonderful to see you again. Thanks so much for joining us.
You bet, Adam. Glad to see you.
Thank you. Well, I appreciate you squeezing us in here at the end of the year. I know it's a very busy time for Oxbow, and I've been encouraging folks to make sure they get their year-end planning done. So I know that it's that busy time of season for you. So again, thank you for making the time here. I got a lot of questions for you. There's a lot going on. If we can, though, let me start by asking you the general kickoff question I like to ask you. What's your current assessment of the global economy and financial markets?
Well, Adam, it's not a lot different it was, 3 or 4 months ago. It's, if you look at China and Europe, obviously not doing so well. A lot of countries worldwide are not doing well. Germany in the tank, UK is not doing so great. And then you have the US, which is doing better. But even in the US, it's a bifurcated market, really. We have so many of the people in the lower 50 or 60% that are not doing well. And then everybody that has stocks thinks, happy days are here again, so to speak. And that's really what you have going on right now. And I think that's shown up in the economy because people are spending those dollars that way. And so it's definitely a bifurcated market in the US. Pretty slow foreign, though. And that's tends to be what we're seeing.
Okay. I do want to get into talking with you about the state of the U.S. consumer. Most of the people I interview are right there with you. It's been a K-shaped recovery since COVID, and these pretty much near record high financial asset prices I mentioned in the intro. That's benefiting the short end of the K. But even with all that, we are seeing some evidence that even the high-end consumer is starting to perhaps pull back a little bit. We're seeing some trouble in sales with some luxury brands and things like that. So I do want to get to you at some point about even the well-to-do consumer who's been kind of pulling things, doing the majority of the heavy lifting in terms of keeping the economy chugging along well and whatnot. Could we start having reasons for concern there? But before we get to that question, let's start with this topic of overvaluation. If you don't mind, I just want to read a couple of stats and then I'll hand the baton to you. So far, the S&P, as I mentioned, it's trading back near record highs, has made 57 new highs in 2024. So it's just been this, unstoppable engine, just again, new high after new high this year. Cyclically adjusted PE ratios are now above 38 times. That's the second highest they've ever been in history, second only to the extremes of the dot-com bubble. There is such a thing out there, I've showed it on this channel a few times before, called the euphoria meter. That, at least in the data set that we have for the euphoria meter, which goes back to the early 1990s, by far at a record high, at least amongst the past 40 years. And then let me just read this real quickly. This comes from Goldman Sachs. Their trader, Mark Wilson, um, sort of summed up the market situation in these following 4 points. From small business optimism to the PPI final demand acceleration, it looks like we're not having any landing right now. No soft landing, no hard landing, just kind of a no landing. Marginally weaker CPI confirmed the disinflationary trend and allowed markets to fully price in rate cuts that they expect this week from the Fed. Number three, Trump and the new administration's rhetoric and appearance on the New York Stock Exchange floor walk fanned the already blustery US political tailwinds, and Broadcom's AI enthusiasm sent that stock up 22% yesterday, added another mega cap tech name to the trillion-dollar market cap club. So we're now at this point where kind of everybody thinks that these super stretched market valuations are just kind of business as usual and expecting it to go forward. This is an environment where Apple is now trading at 10 times sales. Apple, a company that's barely grown its revenues in the past 4 years. Even Walmart, a darling of this year, is now trading at 39 times earnings. So Ted, what is it here? Is it a new world order and we just have to learn to love these new valuation multiples, or are these stretched extremes that will have to mathematically revert?
Well, Adam, for us, we look at the companies, and I know that relates and it comes out in the averages, but there's multiples you're speaking about. But when we go in and look at a company, it's like you look at a business. You're not going to buy a piece of real estate or do an investment in a private company, oil and gas, or anything else that you don't get a great return on cash flow, or at least good enough that you think you can do it. And so when we're looking at companies that are public, we do the same thing. And what's happened now is that people think we're super negative. It's not that. It's just that we don't find the companies that we would want to buy because those prices are too high. Then you put all that together and it reflects into the averages themselves. And I think that's what's happening now, is that people are basically doing a no-brainer. Let's just buy the index and we'll forget about it, forgetting about the concentration in those really, really high-priced companies, which, by the way, we own a couple of them, but we've owned them for many years, and it's not companies we're buying, right now. And if you see them, they're buying those same companies. And by the way, they're doing the same thing overseas. If you look at the MSCI, it's 75% S&P. And so everybody worldwide even is in the same thing. And what we do is we look at a company. If it matches what we think we can make the next 5 to 10 years in that company, we'll buy it. If not, we pass. And that's why we've been passing on a lot of companies. They're just too expensive. And then that shows up in the averages that you're talking about right here.
Okay, so that's got to be somewhat challenging and maybe not super comfortable as a capital manager. I mentioned in the intro that you manage billions in capital for high net worth families. When people see the party raging, have you there kind of suggesting caution and, hey, these things seem too richly priced. I imagine as the party continues to go on, you get more people that sort of start to doubt and say, hey, shouldn't you play a little bit in this? I know you and I have talked about many times on your appearances here, Ted, that you've seen market cycles like this. And kind of what I'm trying to get at is does this look like a top of a cycle to you, and you are choosing to stay out of the mania? And yeah, maybe in the short term, you look like you're missing out, but in the long run, if things play out the way you think they will, you're doing a great service to your customers. Or does this look like something else?
Well, no, it definitely looks like, you can call it a mania or bubble or whatever you want to call it, because what's happening is these prices are such that if you were to sit down on a lot of these companies and whittle out an income statement, a balance sheet, and say to yourself on a cash flow basis, how long would it take me to get my money back? If I could sit down with somebody and show them how we look at companies, I think they would look at the market itself and say, gosh, I'm taking a lot of risk for what I'm getting back right here. So they would pass on it. And that's when you realize you're in this sort of mania bubble, when people quit thinking about the fundamental return of something and they start just thinking about the price. I want to buy this because I was at a cocktail party, somebody bought it, they're making a lot of money, so I want to buy some. Well, that's not a great reason to invest. And you certainly wouldn't ever buy a piece of real estate like that. So, but that's what people are doing in the stock market right now.
So, I tell me if this is a correct concern to have or not, but sure, there's individual valuation risk, right? I mean, we could look at a highly speculative asset like a meme stock or something like that and talk about, okay, maybe this thing is overextended, and if it craters, it's going to injure the risky speculators that are choosing to buy that one stock. Um, but to me, it seems like the risk is more broad than that right now at these valuation levels. You said earlier that the world is concentrated into US stocks. US stocks are concentrated into the Magnificent Seven, and the Magnificent Seven stocks are trading at some relatively crazy valuations. I mentioned the 10 times sales for Apple right now. And my concern, and I've heard folks like Mike Green be much more articulate than I in this, is if you have a correction in those stocks, right, if they are indeed overvalued and they have experienced a material correction, it's not just going to take down those stocks. It's going to take everything down with them because so many ETFs, so many retirement funds, so many pensions are heavily concentrated in those few stocks that the ripple effect is likely to be much larger than the average investor appreciates right now.
Well, that's true, Adam. You're exactly right. What happens, people don't realize, but when they're buying the indexes or buying the exchange traded funds, they're buying them all, not just the seven. So we look at a lot of companies, and a lot of those companies down the lane, they're overpriced too. Like you can go through and look at them, and you'll realize that, well, it's going to be a long time before I get my money back out of this company. So you're exactly right. What happens is they take everything at one time because you're basically down to what I call a one button market right now, which is everybody owns the same thing. And if they want to sell, they're going to hit one thing. And that's going to be those exchange traded funds and that. And then you look at the mutual fund managers. They have 1% cash. They don't have any money. If they were to get redemptions tomorrow, they've got to sell the very same things that people are selling in exchange traded funds. And I don't necessarily think that's a negative for us. We have a lot of liquidity, so we would look at that as, hey, we may get some really good buys out of this before it's all over with. And that's why we look at it from our vantage point.
Okay. And, famously, Warren Buffett has been not buying companies and has been just building more and more cash over the past bunch of years, leading some people to question, hey, has he lost his magic? But a lot of other, longtime Buffett followers say, no, he just thinks the market's richly valued, and especially if you look at his own indicator, right? The Buffett indicator, it's the it indicates the greatest level of overvaluation in the indicator's history. So you could just say that Buffett's being consistent with his own metrics. Sounds like maybe you're taking that type of approach there at Oxbow, which is more of you know, amass dry powder and be willing to move favorably if and when this, the type of correction you think could happen happens.
Well, Adam, that's true. We're getting 4.5 or higher now in the treasuries short term. So we're paid to really wait on things. I think about, I don't know the man, but I know he's got obviously a great track record, and seems to still be with us as far as I'm concerned. But I know a lot of good stock pickers that are really have a lot of liquidity right now, and I know why. That's because you can't. If you buy these companies and you're buying them at an overvalued spot, then your only thing you can ask for is somebody else to come along and buy it more overvalued,
Hmm.
which is just not a reason to invest. And you have to wait until you can get a chance, to buy them. It's really interesting to me. We do business with a lot of different kinds of people, but a lot of them own real estate, and they own private businesses and oil and gas, different things. They would never think about buying things that had the multiples that we have today in those businesses, and yet they'll buy them in the stock market. And that is kind of an interesting phenomenon to me. They don't really stop and think about it.
So, a lot of investing at the end of the day is emotional driven, at least amongst more the retail investor, right? And we've all seen the charts of past bubbles, and there's the famous one of Isaac Newton with the South Sea bubble, where he got in, he made a bunch of money, he got out, he felt great about it, but then it kept going up, right? And when it entered its manic blow-off phase, he saw all his friends getting rich, and so he loaded back up, and of course, the bubble popped, and they ended up losing a ton of money. Um, is what you just described maybe kind of a sign that we're maybe near that end of the the bubble where these people who otherwise would be very prudent are kind of throwing caution to the wind now?
Well, we see a lot of that. I'll tell you, Adam, you're exactly right. Because what we see is this. You start off with somebody and you say, and they will say, well, I want to be mid-range conservative. I really don't want to be 100% in the market. I want some cash flow, various things. And so we know how to do that. But then you get into a market like the last year or two, and I think they feel regret, and so they immediately want to say, okay, I've got to get in this game because I'm losing a lot of money and by not being there. Now, typically that's the wrong time. I will tell you, I've seen it too many times over the last 45 years, and they do it at the wrong time. And they're the same people that at the low of the market can't take it anymore. And they say, well, I've got to sell out because mentally I can't take it. That's just an emotional piece that people need. You know, I always ask people, why don't you do your own sort of investment policy statement to yourself, which is, why am I investing? What do I want out of my investments? And what am I willing to risk to get there? And
Hmm.
if you'll answer those questions, you can come up with who you really are, because who you really are should not be chasing prices because everybody else is chasing them, because that'll never get you there.
You know, it's funny, it won't get you there, and you've got the voice of experience to prove that. But uh, you know, that's an emotional decision. Again, that's when our emotions are usually pushing us to make the wrong decision at the wrong time. And you have math against you, right? Which is, you know, in markets, if something outperforms, um, that usually means it's having an above average year and it was more likely to revert to the mean at some point. So if you're just performance chasing, you tend to oftentimes get into something right after they've had their outperforming year, maybe right before they have their underperforming year, right? You're nodding as I'm saying this.
Well, you know, Adam, I put together a graph last week, and I took the last 5 years, including 24, you know, the last five, and I assume 24 is a full year, all, you know, good returns, all except one. But I mean, it gives you an idea how people are thinking, because the last 5 years have been good for them. And I said, if in the sixth year you have a 40% decline, because we've had a lot of number of those, so it's not out of this
Hmm.
line. You have a 40% decline. You know where you're back to? You're back to a 3% compound return overall. In other words, you got nowhere. If you have a 50% decline, I use the same, these are real numbers now. I use a 50% decline, your return is 0.3. And so people forget about the fact that, yeah, if you can get, you know, easy come, fast move, it goes the other way too pretty quickly, or can. So you've got to decide how you want to invest and how what can you live with. You know, if you want to be a speculator, which is fine. I think if you know you're a speculator and you like that, that's your business, your money, then as long as you know you're that, that's okay. But I think a lot of people have started confusing just what you're saying, speculating and investing, and those two are not the same.
They're not, and we'll rail about this in a different discussion. But I've mentioned frequently in the past that I think we've largely created a generation of speculators when we talk about younger investors, because we've, you know, basically let them grow up believing that highly speculative assets like meme stocks and crypto and whatever are the way to invest. And of course, their mindset is I'm never going to be able to afford a house unless I catch one of these rocket ride stocks. And that's basically like somebody saying I'm never going to get ahead unless I go, you know, bet on the roulette wheel and bet on black and get it, right? So again, we can rail about that later on. But to your point about that chart that you were referencing, um, when valuations, when financial assets become overvalued, essentially what you're doing is you're stealing tomorrow's returns and pulling them into today, right? Which means that generally you're lowering tomorrow's returns. And there's been a lot of people that have been ringing this warning bell for a good while John Hussman's been a very vocal one, and I haven't seen his latest charts on this, but I'm pretty sure they still predict a negative return for the markets for the next decade plus, given current levels of overvaluation based on how he measures it. But even firms like Goldman have recently gotten on this bandwagon where they've warned that, like, yeah, we may have on average 3% returns for the next decade. But to your point, people had big double-digit returns the past 2 years, and they're just kind of naturally expecting that that's going to happen going forward. In fact, it makes them feel more confident that, okay, yeah, past 2 years, 20+%, great. Well, then I'm going to put all my chips on the table because we're going to get 20% next year, right? So you're nodding as I'm saying all this, but again, this is sort of where we come back to math and probability, right?
Well, and people tend to do they tend to have short memories. I'll just say that. They have very short memories. So what happens is what they think is going on, and they think is going to, go on into the future. And so that's how they extrapolate it. But I think what happens with people, and I've seen this before, where they get caught up in things. And yeah, even in 98, 99, we had a lot of young people that were buying into just a lot of companies that made no money, that had no revenues, anything. They lost everything, by the way. And they were sort of beat up for probably 15 years before they finally came back and said, hey, we're going to try it again. There's a good bit of that going on now. I think that they think it's an easy buck, it's an easy thing to do. And we have, let's face it, since the last 15 years, we have not had an extended down period where stocks got cheaper and cheaper and cheaper. And I think that is the one thing that would throw people here, because they are not used to it, right, basically, and they don't know how to trade that kind of market.
Yeah, I've been mentioning recently that people assess probability, and there are certain things where they say, well, look, that could never happen, right? And to your point, I think most investors today can't imagine a point at which they don't ever want to touch a stock again, right? But you've said many times on this program, that's how you know when a bear market is ending, right? Is when the last bull has capitulated and said, look, I'm just swearing off equities forever. Now we're kind of at the flip side of that, where the last bears are basically saying, I can't fight this thing anything more. I guess it is different this time, right? But we have had a number of things happen relatively recently that I don't think people really could have imagined. I mean, the most recent one is Syria, basically a 40-year regime just falling apart basically overnight. I've talked about, the change that we had in the Democratic candidate, where right before Biden stepped on stage for the presidential debate, nobody was thinking that he wouldn't actually not even be the final candidate in the election, right? But all of a sudden that changed on a dime, right? So the point is a lot of these things you think can never happen, a lot of them actually have a much higher probability of happening than you think. And so you've got to, to your point, Ted, ask yourself, what am I really investing for here? And then once I have my goal, then you ask the question, okay, what's the best risk-adjusted way to get there? It's not just trying to beat the market year after year. At least in most people's cases, it shouldn't be. Many people, maybe to hit their goals, maybe they only need to get 4.5% a year. And if so, then geez, don't buy stocks at these rich valuations. Stay in a safe alternative.
Well, and they could, or they should. I mean, the only thing I ask people to think about is what happens if you have a poor economy and prices decline. You need to give yourself some ability to have some choices, and you don't have any choice if you're fully invested. And by the way, if you look at people even over 70 today, they have more stocks percentage-wise in liquid assets they've ever had, going back any graph we can even find. And so they're not giving themselves any really leeway, so that if anything really negative happens, they need to have the ability to either, one, buy cheap companies, or two, feel good at night that they can sleep well and know that everything is fine without having to think about, hey, all of my assets are in the market. If the market goes down, I'm losing money, every week, every month. And so I think people have forgotten, because we haven't had any of that since '09. We've had a 5-week bear market in 2020. 22, we had 9.5 months, but they came right back to new highs. And most people are like, okay, no. And I see the comments all the time. People are like, oh, just buy this market. It'll go back to new highs. And it may. I don't know. All I know is companies they will always trade back to where they should be traded in time, in time. They may not be right now, but they'll trade back to where a company should trade because you can buy and overbuy for things for a long time, but eventually they get back to where they should be trading. And I think that's what people forget.
Well, and this is part of the value that a financial advisor can provide. One, in helping you determine, hey, what are my goals and what's the amount of risk, the prudent amount of risk I should be pursuing to hit them. But then secondly, to remind us of things like that, right? So one of the other things that changed relatively recently too, I think that makes the situation worse, Ted, is we had this inflation spike, right? So people are loath to put their financial assets in things like T-bills, because their mind is still scarred from inflation, and they're seeing financial assets, stocks, continuing to surge here. So they're saying, I got to put my money in that to be able to comfortably stay ahead of inflation. And a chart that really, I think, epitomizes that for me is this chart here, which shows that US consumers have never been so bullish on stocks. They're not nearly so bullish about the prospects for their income. And you can see here in this data series, which goes back to the mid 80s, those two have been very tightly coupled in terms of their correlation. And all of a sudden now we've had a massive separation from this. And what I sort of take from this is people saying like, yeah, I'm not really, all that optimistic about, my earning potential from here, but don't worry, I'm just going to put all in the market. I'm going to make all my wealth in the stock market here. And to me, that just seems like a real recipe for disaster, given what you just said.
Well, and that you nailed it. That is exactly what they think right now. Because if for example, one of the things can happen to people is if they get started in a market at the perfect time, and all of a sudden they've had 2.5 really great years or something, or 2 years, it looks really easy to them. And so they just think about that. See, they're just thinking about price. They're not really thinking about the asset that they're buying. They're not saying, well, if I buy this company, what will that company do for me the next 5 years? They don't think about that. But I think what you're going to get into here, and that is what's going to affect these people, is just think about this, but if 75% of the foreign situation is the S&P 500, you've got everybody here on 60% of the people are in ETFs or the index, and you've got 1% of mutual fund cash. When you hit the sell button on these things, who's standing in to buy?
Right.
That's the one you have. These people don't realize it. And what happens, I think, would be a real shocker to people because they've gone 15 years like this. And, they don't remember January 2000 through the first decade, 2010, they didn't make any money, 1%. So, you can say, well, it's great to be in the index. Well, not always. I've seen long periods when it didn't do anything. So you have to know what you own. But right now, I think everybody is going to just I'd have to say sort of drunk, and they're still drinking it. And so, and when it's like that, we don't try to change people. We're like, this is what we do. We know we'll be okay tomorrow. That's what matters to us. And I would say this to you. In my career, some of the biggest errors I've made my whole life is when I know better, when I know something's not right, but you get so much, that's when I was younger, you get so much pressure from the outside to go along with the group because you have people saying, hey, you're not doing this, you're not doing that, I want to do that. Instead of staying with what you know is correct in the long, long run, you succumb to that as an investor. And I made those mistakes as a young man. You cannot do that because that's where, as an investor, you will beat yourself up over and over again. And that's something you learn over time. But we stick to our guns. And, if it doesn't work for somebody, I understand. But we'll be here tomorrow with your money, though. That's my point. You're not going to have to worry about it. You can go to sleep tonight.
All right. And there's a question I was thinking about asking you that I will ask, given you said that, which is, so just kind of brass tacks. I know your firm, is long assets, but they're conservative assets, things like T-bills and things like that. I know you're invested in other things as well that you think are rationally enough valued right now. But you are largely sitting out the party that's going on in a lot of the stocks that we've mentioned already. Um, and yeah, the question I was going to ask you that I will now is, are you feeling any pressure, any sort of worry that, I don't know, maybe this time is different and maybe our formula is wrong, or are you kind of cool as a cucumber? Like, yeah, this may take longer to play out than I think, but I know from my you know career of experience that this is one of those times where if I just stick to my guns, I'm going to be fine in the long run.
Well, Adam, that's a good question. I think a lot of managers feel that way. We don't really feel that way in this respect. We buy things, like, we give an example, some 5, 6 weeks ago, Boeing came out with a convertible preferred. And when the stock was like, 150, it's about 170 now. And we bought the convertible, pays us 6%, and converts into the common the next 3 years. That's the kind of thing we like to own. It gives us good cash flow. That's a stock that's gone from 400 to 150. Does it go to 100? It might, but we get good cash flow while we wait on it. Last week we took a small position in LyondellBasell, and stock's gone from 110 to 75. It's a 7% dividend. Those are things we look at. Can we live with that? Can we live with those situations to do? In the past 3 months, we bought Conoco, we bought some Colgate. We buy companies that we know are making a great return, and we're willing to live with those companies for 5 to 10 years if they're doing well. And people think that we're super bearish, like we're trying to call the market and get out. And we're not trying to do that. We're trying to say, hey, if we have a company that looks right to us, we will buy it today if we had it. It's just that everything is so expensive that they don't make sense to us. And so we don't step in and buy them. And we probably run right now in all three categories, strategies, about 50% in treasuries that are anywhere from 2.5 years all the way down to 3 months. But that is not to say we wouldn't move it if we had a chance to buy something really, really cheap. But I know one thing we're not going to do is we're not going to chase the index. That's not something we're going to do.
Okay. All right. Well, look, I want to move on to get your thoughts on interest rates and bond yields. I'd say for the past couple months, Ted, this has been the topic that I have seen the greatest differences of opinion on with the experts that I interview on this channel. Some who are convinced that there are macro forces that are going to be continuing to disinflate the economy, and will certainly pull inflation down to 2%, and maybe we'll have a disinflation deflation problem at some point in the future. And then I'd say about half are concerned about entering a secularly higher inflation era. And obviously bond yields are a function in part of inflation expectations. Where do you and your team fall on this?
Well, it's interesting, Adam. I actually agree with both of them, but here's the reason why. I think in the short run, by that I mean the next 6 to 9 months, if you get into any trouble in the economy or the stock market for that matter, and the debt on the US Treasuries, that you could see the Fed have to keep those rates lower or come in lower to try to offset all of that, okay? The problem for us is we think it's a one-time throw. In other words, within 2 or 3 years after that, you'll be back to the higher inflation levels. And one of the hardest things for an individual investor to do is trade the bonds. I've traded bonds a long time. And the individual investor can't do that. You usually buy a bond fund, which are they have long-term bonds. So I think for us, we've decided we will stay within that 2.5 year number, because even though they come down in the short end, we think long-term that it would hurt us to go out and start to buy 20 and 30-year paper. Maybe the only thing we might buy is some very high quality Ginnie Maes, maybe that were 5 to 7 years, but we haven't even done that. I'm just saying for us, we're going to have to stay fairly short, and if the rates come down, so be it, because we don't think it'll be like this last 15 years where they go down and down and down. They'll turn. The Fed's in a really odd position here, because if the tariffs stick and all of a sudden inflation is moving back higher, and you've got a Fed over here that's like, okay, wait a minute, I've got to try to protect the Treasury, and if I push the rates up, you can see it's a catch-22. I would not be in. I want to be in their position the next 12 months. I think it'd be a hard trade for them.
Okay. And in the immediate term, I know the market is pretty rock solid that the Fed's going to cut later this week, another 25 basis points. But we have seen, um, uh, inflation, all the different ways in which the Fed measures it, be sticky. And in fact, a number of those have started moving back up again. Also, the economic growth continues to be, around 3%. These are just not normally conditions under which you see a rate cut. So may we be under kind of higher for longer than the market's expecting here?
Well, that's what I would expect, because unless there's one thing, and I think people forget about this, but especially in the last 7 or 8 years, the stock market is the economy. It's not the reverse. And I don't know of another time in recent 70-year history, I'll put it that way, where the stock market was the entire economy. If the stock market breaks, the economy breaks, period. Everything's hung up on it. I can give you so many examples. And so I think they'll watch out for that. And that's one of the things that would break it. But while I never know what they're going to do, I can't imagine they get aggressively on the downside if you're not getting a break in inflation. And it doesn't look, at least the next 2 or 3 months, that they're going to get that. So
Right.
I don't try to guess with them. We're always looking at, like I say, looking at companies, and that we do the best we can in that area. Try to guess these guys would be and gals would be hard to do.
Okay. Um, well, let's see here. So Fed TBD. We know right now that bond yields have been unimpressed by the Fed's cuts so far. How much does that have your attention? And you know, we don't know what the Fed's going to do from here, but I'm curious, should bond yields continue to march higher? At what US 10-year rate do you start thinking the economy slash the stock market really begins to take notice?
Well, my guess is, you go up closer to 5 again, like we did, some time back. When you start thinking about it, and they're just thinking about this, if people thought the inflation was 3.5%, but all of a sudden I could get 5% on the 10-year bond, they might just say, you know what, I'm just going to buy the 10-year. Forget
Hmm.
about it, because, that'll work. I think the biggest problem, and what should happen somewhere along the line here, the way it's going to go, is that interest rates will be lower than inflation. That's about the only way, without being austere, that you can sort of work out of this thing, because the foreigners are not buying the bonds. If you look at all the bills that have been sold, the Treasury bills the last 18 months, they weren't bought by foreigners. They
Hmm.
were bought by everything you can find here in the U.S. And so that's not an outlet for you. And it'll be interesting to see what this new Treasury Secretary, he understands the game. It'll be interesting to see how he approaches that, because they've done nothing but sell short-term bills purposely so they didn't affect the long end. And that's going to be a problem for them.
Yeah. So how do you get bond yields below the rate of inflation? Um, I mean, a couple of different ways, I guess, but obviously one is the Fed goes out and starts buying the longer end, which it's not on its immediate agenda as far as we know.
Well, I know people don't think they would ever do this, but if it got to this point, they would do yield curve control. That's what would happen. You never put anything past the government. Let's face it, during the Depression, they went out and they took all the gold. You couldn't keep
Right.
gold, so they can do anything. And there's periods where they do a lot of different things. Made you, in World War II, they made you buy the U.S. bond. Well, they could get in a situation where they do yield curve control. If they do that, then rates don't go up, but inflation does. And over a 15 or 20-year period, you work your way out of it. I'm not saying they're going to do that, but it works like that.
Hmm.
And maybe all along, even if they're moving the rates up or down, they're still staying, below inflation. Um, and that to me is where you'll head with all of this. They're in a tough position, because 36 trillion in debt, 107 trillion total debt in the U.S. You've got a debted nation for sure. So you're going to have to think about it.
Well, and if interest rates go up, another point, full point, 100 basis points, uh, that's, what, almost a quarter increase in the debt service, right? So it just
Uh,
makes it even worse, right?
and you know, Adam, that's true. And what happens too to individuals, they don't think about this, but if you own a 30-year bond, a treasury, and the rates go up 1%, you lose 11.2% of the principal. Now, to work out of that on the long term is hard. And I think
Right.
that's what people, they keep putting money into bond funds though. I keep seeing it all the time and I keep asking myself the question, why would you do that? And I know why, because this whole investment management community out here is still hung up on the 60/40. And so, well, we just got to put 40% in,
Yeah.
in income. Well, but we don't think that's going to work the next 10 years.
Okay. And I know we talked about this in times past, and we kind of went back and forth on when would the time be to go long duration in bonds. Sounds like you're saying, I don't know, and I'm not even thinking about it right now. So is it fair to say that most of Oxbow's fixed income positions are on the very short end?
Well, almost all of it. If you look at just a straight conservative fixed income account, which only has fixed income in it, we have about 10% of that account in, when I say longer, 10 to 20-year paper. Most of that's, by the way, in municipal bonds. They're not in treasuries because you do get a premium. You get paid to own the muni right now over the treasury. And if you have a high quality municipal bond, you're going to do better. But 90% of it is going to be really short, less than. We have two bonds. We own an Allstate and a Kinder Morgan bond that's 4.5 years. We get 505 on those. But generally, yes, you're correct. Most of that's within 2.5 years on the treasury because two things, you don't pay state tax. And secondly,
Hmm.
it's the best credit out there. You can say what you want, but it still is the best credit.
Yeah. Okay. One last credit related question, then we'll move on. In the past, you and I have talked about um, the refinancing wave of corporate America. And it's funny, it was a big concern about a year ago, really kind of fallen out of the headlines. Um, I was interviewing Michael Howell about a month or so ago, and he's been very bullish on markets since October 2022 because he's all about net liquidity flows, and that's his whole big model. And he thinks 2025 is going to be a disappointing year for investors, not necessarily a down year, but again, just relative to the massive returns we've had over the past 2 years. He thinks it's not going to be a great year or single digit return for two reasons. One, while liquidity is still rising, we're getting near the end of the cycle, we're getting close to the peak, and so the impulse of the rise is diminishing. But secondly, he's very concerned about the volume of corporate debt refinancing that has to happen in 2025. And he looks at that as like a sponge that will be sucking liquidity out of the market. Curious to hear your thoughts on that. And I know from our previous conversations on this, you've said, hey, companies, they don't borrow at the Fed funds rate. They borrow at prime plus something. So in a lot of cases, especially if the Fed is not going to be able to bring interest rates down super fast, which we don't think they are for reasons we just discussed. Um, a lot of these companies are going to be re-rating their debt at some price that might be like 2 times or more than what's currently on their books, correct?
Well, Adam, that's right. It would be easy though, because a lot of them are out there at 3%. Or some of them are at 3.5. I mean, it wouldn't be hard to go to 6, 6.5 or something like 6.5. I mean, that'd be a good rate actually.
Yeah.
You get that there, but all of a sudden they double. The other thing you have is you have 15 trillion or so in the next 2 years of federal debt that
Yep.
has to be refinanced. So you have, this crowding out effect, and that's what's going to put pressure on them. I know people don't worry about that right now, but it's having problems out there, and we see more and more deals where you can buy something really, really cheap, and the reason is because they're getting murdered on the debt, and they're going to have to cut it loose.
Okay. And just to be clear, that crowding out is uh, the bank says either, hey, I can loan the US Treasury money, or I can loan you, the corporate guy, but because the
Right.
Treasury is having to refinance, they're sweetening my yields, right? My returns.
Right.
The corporate guy, you're going to have to pay up more for this debt if you want me to lend it to you, correct?
Well, that's right. And you don't get anything for the US debt. I mean, right now, for every dollar that they put out there of US debt, you estimate you get about maybe 45 cents of GDP,
Hmm.
45%. So, it's well over 2 to 1. And that's not very good. If you're gonna borrow a dollar, you'd hope that you make 2 or 3 bucks out of it, not 40 cents.
Yeah. Okay. Well, as you have some of your macro goggles on for next year, how worried, if at all, I don't want to put words in your mouth, but how worried are you at all, if at all, about this corporate debt, the impact of this corporate debt maturity wall? Because presumably you could make the argument that it will reduce corporate profit margins because they're now having more, earnings going to pay for interest. And therefore companies are just gonna be able to do less. So the economy will grow less and maybe they need fewer workers as a result and will lay people off. Is that a big worry, a small worry, a medium worry for you next year?
Adam, just depends on the company. I mean, we have a lot of these companies that financed long. I mean, I'm talking about 10, 15 years at 1.5%, that sort of thing. Well, they won't be affected. But the ones that did the floating rate, particularly out in the private sector, did the floating rate, are the ones that decide, hey, we're only gonna go out and do 3 years because we'll flip this asset within 3 years, but then they didn't. And then they've got that debt and now it turns. Those are the ones you have to think about. I think a lot of that's in the private sector. And the banks, when they come to the banks, because I'm involved in one, and you have them come to you and they say, hey, we want to see what you will do on this. And most of the banks are saying, well, probably nothing. We've got all we want in that area, so we're probably not going to add on a lot.
Okay. So this just sounds like one potential risk factor to keep a close eye on. All right. So as we go into this new year, Ted, obviously one thing that is going to be quite different about 2025 is it's going to have a different administration in power. And we have, I think, a decent sense of the main pillars of Trump's economic plans. So I guess I'd just love to get your thoughts on what expected impact you think that will have on the economy and the markets. And maybe in your answer, if you can address, a lot of Trump's plans, common theme is disruption. And can Trump be successful with his plans in the long run without creating some real short-term pain of transition for the markets and for the economy?
Well, Adam, if they do what they say they're going to do, and I don't know that they will, and maybe they won't because it's too drastic. But if you line up tariffs, and I think we'll know more about that in January because I think they meet with Mexico. But if they line up tariffs on all these countries, let's say it's 10%, say it's half of 10%, it's 5%, that's still going to be inflationary, very inflationary. So now he has a conflict between his policy and the Treasury and the Federal Reserve. That's a problem. That would be a problem they would
Hmm.
have to address. On the second side of it is people probably forget who the biggest employer in the United States is. And when you go in and decide you're going to really cut this machine down, and I'm sure I know there's a lot of fat, a lot of things that are not efficient, no question about that. But when you do it, you also put a lot of people on the street, and those people are then going to be looking for a job or drawing unemployment. All of a sudden, you can see what happens in the general sense of things. And so for what we're looking at is to see if all these people that are in all these different categories, and I think he's named some good people, not necessarily all of them, but I think a number of them are good people. I think you're gonna have to look at that and say, can they all come together and say a cohesive force to make it work right? If they can't, in other words, if they're bickering in between, with
Hmm.
each other, then you have a problem. And I think that's what we'll be looking to see, what's going on, because uh, it's interesting. The president coming in, President Trump, he looks like he's de facto president right now. He's already naming and talking and going
Yeah.
overseas and doing things like that. So I'm assuming he's going to have all these people in place if they get approved. But I think that's what we'll be looking for. Things are never as good or bad as people think they are. So we'll have to stop and see how it goes.
Okay. And let me ask you a question on that last point you just made. I put this idea out to Twitter, or X, and I'd be curious to get your thoughts on it. We just had this presidential election. Trump won and won the popular vote this time. So one might say that, we have had a lot of division in America between the left and the right. And not that that's been resolved by any stretch, but you know, Trump seems to kind of have a popular mandate at this point in time. So maybe we are a little less divided than we were, say, a year or so ago. We also had Syria, which I just mentioned, right? Syria, the Bashar regime, just the Assad regime just basically evaporated overnight. And Israel went in and carpet bombed all the military installations it could. But given Israel's relatively recent moves amongst Hamas and Hezbollah, and then now here in Syria, recent events seem to have weakened Iran, strengthened Israel, therefore potentially leading to maybe greater odds of some sort of negotiated peace between the two countries. When you have a guy like Trump coming in, who has basically said, I'm going to make sure these wars end, um, it may also increase not just an Israel-Iran peace odds, but also a Russia-Ukraine one. So my question was just sort of like, is the world suddenly actually becoming more stable? Like, is this something that could actually be kind of bullish for the economy and markets over the next several years? Like, I know it's really early on, but those are pretty big developments. Like, should maybe we look at that and say, yeah, some of the things we were really worried about over the past couple of years, we may need to worry less about.
Adam, that's a good point. One of the regrets I have is I haven't spent much time in the Mideast and all those countries you're talking about. So for me to talk about it with any authority is poor because I can look at what I read. That's all I can look at.
Mm-hmm.
And I would say because the world is becoming really polarized right now, I would say no, it would not be a world that will be most settled down. I think you've got these countries that are pretty fed up with the U.S. I'm talking about the BRICS and a
Mm-hmm.
lot of the South American countries, and they're tired of the bully look that they've given them, and rightly so, by the way, in many, many cases. And so they're like, hey, you know what? We're going to try to do our best to get away from the dollar. We're going to try our best to um, really run our own situation. And I just saw some of the South American countries and European Union, they've gotten together and said, hey, we're not going to do tariffs with each other, so we'll trade together. So yeah, no, I don't think it'll settle it down. I wish it would. It'd be nice if that happened, but I would be surprised if that happened.
Okay. Well, look, thought exercise, and I am no geopolitical analyst either, but maybe we can all hope a little bit
Yeah.
that that
Yeah,
maybe
always hope for
despite
the
some of the
best.
dust that might be happening.
Right.
All right. Well, look, let's get to the so what part of the conversation, Ted. All right. So we've got a pretty good sense of how you and the team at Oxbow are looking at the world and the markets right now. You've given some nod to how your portfolio is positioned, but given the road you see ahead, how are you planning to navigate that with the assets under your control there at Oxbow?
Well, we came out with a sort of our own policy about 2 years ago, Adam, and they said, we've said that 60/40 is never going to be again. That we thought it was going to be more of a 30/30/30/10.
Hmm.
And by that, I meant you need 30% in short-term fixed income, short-term. Your 30% can be in value, growth, equities, 30% in real assets because of inflation, and 10% for trading. But in all of those assets, we think you'll have to have some capacity to do some trading. In other words, you're going to have to get capacity to add in at lows, take out at highs. I don't think the investment community today has that. They don't have that skill. And so I think it's going to be very, very hard for people if we go through a period where you just have a lot of ups and downs, ups and downs, and ups and downs, and then they look up 5 years from now and say, well, I've only compounded 3 or 4%. And one of the reasons is because they didn't make any moves. And
Hmm.
so that's why we think the 60/40 won't work. And you're going to have to do something differently if you're going to make any money. And I think people will learn that skill, but it'll probably take them 5, 6, 7 years to do it.
Okay. And when you say that skill, you really mean active investing, right?
Yeah, I mean,
We
that's right. I mean, because what's happening is people forget about this, but if you go into a period where commodities, we think eventually for the next 10 years will really outperform, maybe not the next 12 months, they might not, but you have to get set up for that. If you think commodities will do better and you think real assets will do better, metals will do better, oil will do better, all that sort of thing, then you have to get set up for that. But there's times when you will add to it and times you'll take away from it. And I don't think we're in that mode where you can just go out and buy a bond fund or long-term paper. It's not going to work. And even if it worked for the short term and the long term, it won't work. In our opinion, anyway, maybe we're wrong. Maybe we go back to this 0.25% interest rates for 5 years, but we think all those days are gone. And you're going to have to be willing to know what you own, when to own it, and when not to own it. And I think that's the difference the next 10 years.
Okay, so it's the Kenny Rogers approach, the gambler approach, right? Know when to hold them, know when to fold them.
Yeah.
I just want to opine on this for a second because it's somewhat what we were talking about earlier with creating this generation of speculators versus investors. Is I would say most adult investors, retail investors at least, but probably a fair amount of institutional, they've cut their teeth in a world where passive investing worked. It was easy, right? You just bought whatever, the index, the sector ETF, whatever, and you held on, you bought the dips, you did just fine. Sounds like you're saying that era is over, for better or worse, and you just got to, make sure you're playing by the right playbook for the times going forward.
Well, Adam, I've run the numbers on this a lot of different ways, and almost 40% of the people in the investment advisor business today are less than 45 years old, which means that yes, they've only been around the last 15 years. So if you've got almost half the industry, and by the way, the top 20%, they've already sold their companies and they've headed to the house. So you've got a group of people that are going to be running the assets that are not used to that sort of thing. And I think I can only tell them what happened to me one time in the early 80s. This was after the 70s. All during the 70s, the market would just stay in a 25% range. It did it for 15 years. And I never will forget an investor asking me this question and saying, look, I was really a young guy. And he said, look, it looks like to me that we didn't have a large fee by any chance, but he said, it looks like to me that you've made more money than I have. And I said, well, you got a point in that because, we're just not going anywhere in the market. Well, that won't work for investors. You can't say the market's down 25, you're down 25, the market's down 35. All they know is we're down 25, okay? That's it. I think that's what's going to be hard to do. You can't sell that relative performance the next 5 or 10 years, and I think that will become the problem for these people that have not been through any really, really long bear markets.
Great
Think
point.
about it. They weren't even around between 2000 and 2010. They didn't even see those markets.
Right.
I mean, so for them to be able to say, hey, I've got experience. Well, not really. Your experience is the last 15 years, which is a la-la market.
Which is, concerning because you're basically saying the majority of our capital management fleet kind of essentially has the wrong musculature for the road ahead, right?
Well,
And
it's
one reason
true.
why I
I
think
mean,
people should seek out advisors who have people or at least advisors on their staff that have that basis of experience of what a market that looks like the current market, how it behaves.
well, it's true. And I mean, if you look at the number of MBAs and CFAs and all of the people that have gone into this industry the last 15 years, people with degrees in art and English and anything else you want to think of, could they look at a balance sheet or an income statement? No, they couldn't run those numbers for you. So my point of that is we have this industry stacked full of people. And if you think about it, everything's about the market. Everything. Anything you want to touch is about the stock market. Pension plans, people's assets, companies, all sorts of things, and so everybody is hung up in this one thing. And that's really long-term not the way it probably will work out. I mean, you'll have to get back to what the economy's doing. But I think the people in the industry, that's my point. I don't think they will ever have that ability to, they can in time, don't get me wrong, but it takes a long time for them to figure out that, hey, something's changing here. And I know I was a young guy. I know I had to go through some changes that made me realize, hey, I'm only one little guy trying to learn this thing, and I need to be able to make some changes here.
Right, right. Well, and as a client, you don't want to be paying the tuition, from your wealth for your
Yeah.
advisor to learn this lesson, right?
No
Yeah.
on-the-job training. You're right, Adam.
All right. Well, look, Ted, a fantastic conversation as always. As we begin to wrap it up, let me ask you this. Is there anything I didn't ask you that is burning brightly on your radar that you think is worthwhile to impart to the audience here?
Well, not particularly. I always just try to remind people, you know, give yourself some ability to have choices. That's all I would remind people. No matter what you do, if you're investing in all real estate or all private companies, whatever you're doing, you might want to think about balancing that out a little bit so that you give yourself some choices. And I think that's what people need to remember, because when you go through harder times, what you want to be able to do is know who you were, know how you want to get there, and understand that I can sleep well tonight because I know where it is, and I know I'm not going to wake up tomorrow and not have anything. And I've told people this before. I said, look, if the market closes tomorrow, we get a lot of cash flow from our companies. We get paid from the treasuries. If it all closes, we'll still get that. You won't get that if you're buying the speculative companies or Bitcoin or all that. You won't get that, okay? I'm not knocking that stuff. As long as you know what you're doing, that's fine. I'm just saying that's not what we do, because I think you're going to have to sleep well at night, and that would be my only advice to them.
All right. Well, look, in speaking of what you do, for folks that have really enjoyed this conversation, Ted, would like to follow you and your work between now and your next appearance on this channel, where should they go?
The best place, Adam, is oxbowadvisors.com. You'll see everything there. We're very transparent. You'll see our newsletters. You'll see anything we do, put out, interviews, books. We have 11 books. Have a new book out next spring, or about in January, I think. So it's all there if you want to partake in it. We don't try to hide anything.
All right. Well, Ted, when I edit this, I will put up the link to your website there on the screen so folks clearly know where to go. Folks will also have the link in the description below this video as well. Two things, Ted. One, I hope once your book comes out, you let me know, A, so I can get a copy of it, but B, so we can get you back on the program here and talk about it. I'm a big fan of your books. You do a great job of writing what I call kind of hyper practical books. And I think you also respect the reader's time. You don't make them like really dense tomes. They're something you can get through, in a relatively busy week.
We say on a 2-hour flight, from 2.5-hour flight, you can read it. And this next one's interesting. It's about second generation wealth and what that does to that generation and how you should approach that if you have a lot of money. It may be a little controversial, but it's just what I've seen in many, many years of watching people. So we'll find out if people like it or not, because we find out pretty quickly.
All right. Is it pretty much how to avoid the shirt sleeves to shirt sleeves in 3 generations problem?
Yeah, and it's about what do you really want for your kids? We really feel like that people with a lot of money forget that, what you really want for your kids is to give them self-esteem, the ability to stand on their own 2 feet, whether they had your money or not. And I think people forget about that with a lot of money, and they think they sort of shirk their responsibility, in my opinion. Let's just take care of it with money, and I'll worry about the rest of it later. But they're forgetting about these are real people that have real feelings, and those people you want to be able to stand on your own 2 feet, even if you didn't give them any money. And we write a lot about that. Hopefully people will see it. I mean, we've seen some great examples of people who do it really, really well, by the way. So that we've got that in the book as well.
All right. Well, again, can't wait to be alerted about it when it comes out. Also, I hope somewhere on your website, you've got a link to your holiday music playlist. This is something you've been doing for decades. And I know that the new one just came out because I just got my notice from your team mail with it. Yeah.
Well, I've done that for I go all the way back to cassette tapes, but I love music, and so I've something I always have. I tell you what, I think I'll check with the guys. I think we can put a link up on the website where you just open it up. It's a Spotify link, and just music. It's not me singing. Don't get worried. It's really some very very good artists. You'll know all of them, really.
Oh, it's wonderful. Yeah.
So we'll put it on there so people have it.
Oh, great. And if that turns out to be problematic, just have them send me the link and I'll put that in the description below the video as well.
Okay.
All right, Ted, well, hang with me for 1 second. I've got 30 seconds of housekeeping, and then I want to give you the last word here. Folks, if you've enjoyed having Ted on the program, would like him to come back on as soon as his book is out or whatever trigger gets him back on the channel here as soon as possible, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Ted's firm manages money primarily for higher net worth individuals, but obviously if you like what you heard here from Ted and want to talk to him and kick the tires of his firm, go to Oxbow. If you would like some help, perhaps additional help from that, Thoughtful Money has its financial advisors you see with me here on this channel week after week. If you want to schedule a free consultation with them, just go to thoughtfulmoney.com, fill out the short form there. And again, those consultations totally free, no strings attached. It's just something that they do to help. All right, Ted. Oh, by the way, when you're there at Thoughtful Money, folks, don't forget to hit the link at the top of the website to sign up for our free newsletter. And for those of you who are already signed up to the free newsletter but haven't yet upgraded to premium, where you get my Adam's Note summaries of all these interviews, like today's one with Ted, the macro pass reports, the discounts on our events, and the other benefits that you get, exclusive content, etc. Highly recommend you upgrade now, because that price is going up starting January 1st. And if you sign up now, you'll get grandfathered in at today's lowest price for as long as you remain a subscriber. And yes, those of you that subscribed last year at the very cheap rate, I think of only $8 a month, as long as you remain a subscriber, you'll keep getting grandfathered in at that. So again, I want to grandfather in as many people at the best deals that I can. All right, thanks for your patience, Ted. Just last question for you is, as you know, most of the people watching this video, while we do have some professional investors, it's predominantly regular retail folks that I think share a lot of the concerns that you have about valuations and some of the macro risks we talked about. And they want to grow their wealth prudently, but more importantly, they don't want to lose it all, right? They don't want to become collateral damage to, some sort of big market correction. What parting bits of advice might you have for them?
Well, especially right now, I would tell you, whether you've got 250,000 or 50 million, you need to remember right now is a time that it would pay you to have some short-term liquidity. You can't time, you don't know when a market's going to break or anything like that. Neither do I. It may go on another year like this. I don't think it will, but it could. But whether or not it does, you need to think about giving yourself some ability to make some changes where it doesn't affect you overall. And that would be my biggest concern for people right now. And I see it, is they're not giving themselves any choices if things don't work out exactly right. So no matter how much money you have, you need to have a safety valve, because there will come a time when you will need it. And that would be my parting notes to people.
All right, Ted, very wise words. Thanks so much, Ted. It's always a true joy to interview you. Thank you for coming on. I wish a great holiday to you and the whole team there at Oxbow. Thanks so much, my friend.
Thank you, Adam.
All right, everybody else, thanks so much for watching.